Theta and the bull put spread. So let's remind you what theta is again. Theta is the rate of decay in the time value of an option. So remember, options are valued according to real value plus time value. And the time value element is eroding on a daily basis as you get closer to expiry. Because remember, options are time wasting assets. So looking at your quote below, you see a quote here for QQQ. So that's an index that tracks the NASDAQ. And you can see here we're looking at the May 27 quotes. So we're going to do a 102-100 bull put spread here. And we're going to focus on the theta values on the right hand side for now. So you can see that the theta value for the 102 strike is minus 0.0219. What does that mean? That means that the value or the time value element of the 102 strike is going to erode at 2.19 cents per day between now and expiry, or between now and May the 27th. The $100 strike, you can see the theta is lower. It's minus 0.0174. What does that mean? That means that the value of the $100 strike will erode by 1.74 cents per day between now and May the 27th. So as the share price is moving, the theta values move also. So you're going to notice, and we'll talk about it later again, the theta value gets lower as you go further out of the money and further in the money. And we'll talk about that later on as well. So let's look at that example and how the overall theta effect is going to be for the entire bull put spread trade. So remember, we were selling the 102 put, we were buying the $100 put. That creates the bull put spread. So remind ourselves of what the theta for each strike was. So the 102 put theta was minus 0.0219 and the $100 put theta was minus 0.0174. But remember, and this is the key element of it, we've sold the 102 put as part of the bull put spread. So now our short 102 put theta becomes positive for us. Because just think about it, if the value of an option is eroding by theta every day, well then that in essence, if the share price didn't move, makes the option cheaper to buy back. So it's working to our advantage. So the theta becomes positive. So it's positive 0.0219. We also still have our long $100 put position, and the theta was negative 0.0174. So the net theta for the overall position is 0.0219 minus 0.0174, which gives you a positive theta of 0.0045. What does that mean? It means that theta is working to our advantage for the bull put spread. It means that as each day is passing, the value of our overall position is eroding by just under a half a cent per day. So for something that we've sold or we've originally, we can buy it back cheaper if the share price doesn't move that much. That's why theta is working to our advantage in this particular strategy. But remember, theta also moves as the share price moves. So after you've placed a bull put spread, the effects of theta really depend on where the share price is trading. So with our QQQ example, if the share price trades closer to our higher strike, which is the 102 put option, our profits are usually going to increase at a faster rate as time passes. However, if the share price has moved against us and it's now trading closer to the lower strike price, in our case the $100 strike, losses will usually increase at a faster rate as time passes. So let's look at our QQQ example again. So remember here, we're looking at the QQQ, and it's trading at 108.45. And if you look down here at the moment, we did our 102 $100 bull put spread, and you can see that the theta value for the 102 was higher than the theta value for the $100 level. But let's say the share price got stuck in the middle down here somewhere. If we come up to the other end to get an idea of what this would look like, let's imagine we had placed 2 to 3 weeks ago a bull put spread at the 108 110 level, and the shares are now trading closer to the 108. You can see now that the roles have reversed. The theta value is now switched to the lower strike. In other words, now theta is working against you because the share price has now moved closer to the lower strike. So there's a classic example of how Theta can work against you if the share price moves down closer to the lower strike price.